Thank you. Good afternoon. So a strong set of results published today, demonstrating continued organic growth across the business, which follows a period of successful integration and new product launches over the last year. So yeah, as you know, we came to the market as a buy and build strategy in 2020 and very much focused around integration last year to ensure that we retained our customer base and consolidated our revenues within our expectations post-acquisition. We invested quite heavily in new products and tech platforms last year. So over the last 12 months, it's all been about ensuring that we delivered consistent results, which we're pleased to have done. So organic growth has come through post that, with revenue up 50%, earnings up 55% to 4.7, but more importantly, finally starting to generate operating cash flows and delivering a PBT of 1.1, up from a loss 2.2 the previous year. So I think what's important is to see that we put the foundations in place to deliver strong end of year expectations, that we're now focusing very much around improving our cash generation. It's still slightly below where we would like it to be. We're on a trajectory which Crispin will talk about of improving that. And we've got a very, very clear and deliverable plan to make sure that happens. We're also, as a board, reviewing a number of strategic options to see how we can strengthen our balance sheet so that we can underpin and support the growth that we are expecting. And we believe that will enable us to have a smoother trajectory to continue to grow the business. So for those that aren't familiar with our business model, we've got two divisions, two businesses. Energy management, which is a supply side business which enables customers to access the lowest cost clean energy. Very much a technology driven business, a platform business that allows us to deliver a 3 to 5% saving on procurement of energy. A business that's been the culmination of 20 years respectively of two businesses we've acquired, migrated under a single brand. Very strong gross margins, 78% gross margins, and a very sticky customer base in reoccurring contracts where we're able to see an 85% plus renewal rate coming from those customers. This is a business that has 130 strategic customers with consumption of 5 gig or more, and 190 odd customers that have got a position of 1 to 5 gigs in what we call mid-market. So a very strong recurring business, very predictable business, an essential service that customers need, and a business which we are looking to develop into more of a consulting play over the next 2 to 3 years. So maintaining our supply side business as an entry point to businesses, but very much expanding into providing compliant carbon reporting, carbon compliance, and net zero consulting advice to companies, large organizations that are looking to decarbonize but need a strategy. Our measure division, which is around our smart metering business that we acquired back in 21, is a smart metering and analytics platform. This enables customers to see and visualize granular energy consumption within buildings. It's proprietary owned. And over the course of last year, we were very much focused on developing a product which we were funding on our own balance sheet. And now we have got an off-balance sheet solution funded by two financial institutions that will enable us to develop a much more cash generative business model, which allows us to see strong gross margins, but also enables us to wrap that product up into procurement and supply side services. So to give you an example, within our schools environment or our multi-site retail environments, customers are able to pay by subscription £70 to £100 a month per meter, per distribution board within their buildings, and also access our procurement services at the same time. So it gives us recurring revenues as we begin to scale that business, and also allows us to be differentiated in the market. And we see that as being one of the strong growth levers that our energy management division is going to be building out. It also is a nice segue into providing data insights and consulting services once we get data on behalf of customers. In our energy services division, we do use the measurement technology as part of verifying savings for customers. But the core service that we offer is around reducing energy consumption through energy efficiency solutions such as lighting and controls. We focus on education in this marketplace, but we are expanding into broader public sector customers. We've been very successful this year in penetrating the healthcare sector and also more widely into education, local authorities, further education, higher education, and universities. We use third-party funding solutions to unlock savings for customers. Again, balance sheet light for us. We maintain strong margins, and we've been consistently hitting strong margins in this division despite inflationary pressures across the market. And we've got a market-leading position in the education sector, having done over 1,200 projects now. Huge market to go after, a very deep and wide niche. There's still 25,000 schools, effectively addressable by our products and services, and we've established ourselves as a leader in this marketplace. Last year, to complement our energy reduction services, we launched our renewables division, which comprised of a solar as a service solution and also a EV charging product. The EV charging product has got good traction, and we're looking to continue to add EV solutions as part of all of the other services we provide our clients. But the solar business has really taken off at pace, and we're starting to see real growth coming through this division now, with margins of 25 to 30%. A number of growth drivers that are consistently here this year as they were last year. The difference, I guess, this time is that we've got a year's worth of high energy prices behind us, and although energy prices come off from what were exceptionally high levels last summer, we've essentially seen a sort of a circuit breaker in people's mindsets who run organisations that the decarbonisation agenda is here to stay, whether that's driven by compliance and regulation, or whether that's driven by financial objectives to reduce OPEX costs, or whether it's simply to meet sustainability goals that are imposed or that are desired through the organisation. I think it's fair to say that decarbonisation and delivering energy savings is now on the agenda and here to stay. And as a business that's established itself as a market leader in our various market niches, we're in a very good position now to start leveraging climate solutions for our customers. I think two things differentiate us in the market that are significant drivers. One is the as a service solution that doesn't require a customer to invest its own capital. As we move into a more capital constrained environment, this is ever more important. And we've established a wider panel of funders over the last 12 months that help fund a variety of different products and services. I think also having an integrated proposition is a big benefit to our business, because we're able to act as a one-stop solution for a customer looking to decarbonise without having to go to multi-service providers. And we've seen evidence now that once a customer starts engaging with one of our services, we can quickly start cross-selling and servicing that customer in a variety of different ways. Sometimes that's leading with energy reduction, sometimes that's leading with energy advisory consulting services. And at the heart of everything we're doing is technology. So whether that's our unified platform in energy management, which allows a customer to enter through one digital portal, where they're able to look, manage and control all of their energy data in one place, from their supply contracts through to the savings that they're either looking for or they're experiencing. Data platforms around sub-metering are also fed into that platform. And then the proprietary technology we've got within our tools and apps that we've developed for the energy services that allow us to collect data from sites and turn them into automatic proposals, which sets us apart from the competition. So I'll hand over to Crispin to talk through the numbers, and then we can talk about the outlook.
Thanks, Harvey. So I'm pleased to report another period of significant growth across the group. revenue of 33.2 million was up 50% on the 12 months period to June 2022. And that drove adjusted EBITDA growth of 55% to 4.7 million. Exceptional costs were significantly down on the comparable period, which included the costs related to the acquisition and integration of utility team. That's enabled us to report PBT of 1.1 million, a marked turnaround on the 2.2 million loss before tax for FY22. I'm pleased with the continued significant momentum in energy services in particular. 26.4 million of TCV was signed in the period. That was up 76% from the 15 million in FY22, and with a high level of repeat business. There's strong momentum in eSolar in particular, with 29 megawatts under signed contracts or heads of terms at 30th of June 2023. Solar has long lead times, so that pipeline at the end of June had taken several months to develop. But it's now mature, converting into revenue in the current period and giving visibility on FY24 revenues. I expect solar to be a key growth driver of the business going forward. We show on this side a demonstrable track record of revenue and earnings growth since coming to the market. That's included through an intensive integration period. We're continuing to deliver strong organic growth in both parts of the business. We've got clear momentum for the rest of FY23 and beyond. Strong execution across both parts of the business has delivered 50% revenue growth. We're pleased with the 5% organic growth posted by energy management off the back of a period of intensive focus on integration and challenging market conditions with unprecedented volatility in energy prices. Our investment in the service delivery platform will ensure a best-in-class customer experience through the life of the relationship, which should maintain and enhance what are already high retention rates, underpinning future revenues and improving quality of earnings. We've seen particularly high growth of 87% in energy services, reflecting the execution of the cross-sell strategy, favourable market conditions which support compelling customer economics. Sustained momentum in new business wins give a strong foundation for continued growth. That strong revenue growth and the benefits of operational gearing drove 55% adjusted EBITDA growth, with the EBITDA margin up 40 basis points from the prior year. We've maintained product gross margins despite inflationary pressures and reinvested those profits into sales, marketing and delivery to drive long-term growth. And we're continuing to see the benefits of that investment. We have seen a significant increase in working capital. That reflects a stronger balance sheet, but it did lead to a funding requirement for the business in the period in November 2022. That growth in working capital was driven by a 6.2 million increase in accrued revenue, which represents contracted future cash receipts for the business. That growth partly reflects the organic growth in both energy services and energy management, and is accentuated by the longer lead times on solar projects and the interest we retain in completed funded projects, which deliver a recurring contracted cash flow to the business over the contract life. The 1.8 million pay down of legacy liabilities represents a major step forward for the business and a strengthening of the balance sheet. We did a good job negotiating the contingent consideration related to the utility team acquisition, which we managed to settle well below the amount provided in the balance sheet. The payment we did make was largely settled for non-cash. There's a 1.1 million increase in other net working capital, which largely relates to a non-cash remapping of balance sheet line items as part of the new ERP implementation. Whilst the position has stabilised during the period, improved working capital management and cash generation remains the key management focus. That working capital improvement has helped stabilise net debt after significant cash burn in previous periods. This is notable looking at the second half of the period, which delivered a cash inflow from operating activities of 0.7 million compared to a 2 million outflow for the first half. This reduced the net debt increase in that 6-month period to 0.4 million after paying 0.9 million to clear the historical HMRC overdue amounts. That's a significant improvement from the circa 3 million plus increases in net debt in each of the previous 6 months periods. However, cash generation remains below target levels and is a key focus for management. Good progress has already been made on that front in energy management, with improved contract terms negotiated with energy suppliers and growing contracted cash flows from customer contracts signed in previous periods. That's put the business on an improving trajectory, with cash conversion increasing from 34% for the 12 months to March 23 to 63% for the 12 months to June, and a clear path for further improvement to a targeted 75% operating cash conversion in FY24. Migrating energy services from 50% operating cash conversion to a targeted 75% for FY24 is now the key focus. The off-balance sheet funding solutions are in place for all products, with new facilities to fund MyZero and solar now drawing down, and a focus on improving operating margins will flow through into a further improvement in cash conversion. We've commenced a process to refinance the group's corporate debt facilities ahead of the scheduled repayments dates early in 2024. We have initial positive engagement with interested parties. As we stand today, we have visibility on 90% of full year revenue expectation, full period revenue expectation, I should say. We have a robust near-term pipeline to support the remaining new business wins, and the key focus for management is to deliver this growth in a way which is more cash generative.
Thanks, Crispin. So look, we're very excited by the market opportunity, having built a strong presence and brand in our markets. We think we're well positioned for what will be a really exciting 5-year horizon. We think that education remains a huge opportunity for multi-service, multi-revenue revenue lines across the group, and we think healthcare is going to be sort of the next pivot for that division. The move to profitability is incredibly encouraging, and whilst we're still slightly behind where we would like to be on a operating cash ratio, we've got intense focus from management to make that our priority. We're looking to increase margins where we can, and we're making sure that we are reducing the exceptional item layer that previously has been a big expense item to the business as we come out of integration. Revenue remains a strong growth focus for our teams, and I think that as we look at our pipeline, which is increasingly stronger quarter on quarter, we can start getting more midterm visibility. And at the heart of everything we're doing is product innovation and tech differentiation, and we think that's going to help that operational gearing, in particular with energy services, which, as it stands at the moment, is a 10% EBITDA business, but where we have an aspiration to turn that into a 20% EBITDA business over the next 2 to 3 years.
Thank you both very much. Extremely helpful. So let's make a start on questions. On MyZero, how does the off-balance sheet solution work? Do the financial institutions own the meters once they are installed and generate rental revenue from them?
So we have a fairly straightforward operating lease model with MyZero. We've got 2 institutions that effectively buy the receivables. The meters are owned by the customer at the end of the 3-year contract. So the financial, the funder effectively takes charge over those meters in the period of refinancing, but the client is also paying us a data services fee from day one. So it's a service contract split into 2 parts. The hardware is financed by a third party. The client keeps the hardware at the end of the 3 years, but the customer still continues to pay us the data services fee. So that then leads into a recurring revenue for us, and we're taking a margin from the hardware installation as we sell the receivable to the customer, to the funder.
Okay, and how does this differ? How does the MyZero meter differ from other smart meters that are available?
Okay, so the majority of smart meters, in fact, almost exclusively in the market, people refer to smart meters. We're talking about a meter that is the main meter. So you're seeing half-hourly data. What you're not seeing is an intelligent sub-meter, which allows the meter to pick up individual circuits or individual assets. So if you can imagine in a domestic scenario, you might have a smart meter that shows you how much electricity your home is using in that half-hour period versus getting a breakdown of how much your kettle, your dishwasher, your lighting is using at that point in time in sort of 1 minute intervals. That's the difference. So we pick up granular information. These meters can be installed without de-energizing the sites, so you don't have to shut down a premise to be able to install. It's been a piece of technology. There's only a handful of products like this in the market. We're one of only a few. Centrica bought one of our biggest competitors in 2018, called Panoramic Power. It's a well documented, available kind of peer group comparison, and Centrica now has embedded that across the world as part of its business energy solutions offering.
Okay, thank you. Solar. In solar, are you mainly working with schools, as in this week's contract win, or are your customers quite varied?
They are actually quite varied. We see schools as being one of our large growth markets simply because we've got so many retained customers, and we've got 600 schools under contract for lighting, for example. Every one of those schools either has a need or is thinking, and less than 5% have transitioned to solar. So it's a very addressable existing client base. So clearly that's going to be one of the markets we're targeting, as well as new schools. But then actually our energy management division and our new business sales engine within the sort of commercial teams are picking up, quite a wide variety of commercial industrial opportunities. And we've done a number of contract wins across our commercial industrial clients, and we've also done quite a lot in the healthcare NHS space as well.
Okay, thank you. And what is the value of a typical solar project?
So historically, I would say there's been somewhere between 150 to 200,000 kilowatts, so £100,000 to £200,000 per project. However, we're starting now to see some of the larger contracts that we signed at heads of terms to start to drop with values of £1 to £2 million. We saw one this week drop, which was 3 million contract value. So what we are anticipating is more larger multi-site solar portfolios signing that are around the 1 megawatt. And 1 megawatt is somewhere between 700 and £1 million worth in value.
Okay, thank you. Is there still good growth to come from light as a service? Have high interest rates made these projects more difficult to fund?
So it's an excellent question. So the answer to that is there's a huge addressable market still, in particular the public sector, which has got very aged Victorian style buildings generally. We've seen all of the media around crumbling concrete, but it's just an illustration of just quite how aged our UK public sector estates are. The schools market still has 90% addressable roof space for solar and 90% addressable energy efficiency opportunities. We've got less than 2 or 3% market penetration in the market, and so we still see light as a service to have a 5 to 10 year horizon at the very low end, and possibly 15 to 20 years when you start to see retrofits being on retrofit. So we're often seeing now stage 1 LED solutions that were put in 2015 being surpassed by new technologies that can still save 50%. In the commercial space, I would say it's a highly competitive market between customers wanting to pay for solutions themselves. The return on capital and the payback for lighting came down significantly with energy prices reaching the levels they were at. However, given that the UK corporate environment is so capital constrained right now, it's not necessarily, can I afford to do this? It's a case of, can I prioritize lighting over something else that I might want to do? So we often find that we give customers, whether that's commercial or public sector, the opportunity to do more than one thing at the same time. So there is this race to decarbonize at the moment because of the pressing nature of energy prices, but also because supply chains are increasingly putting pressure on big corporate customers to reach certain levels of decarbonisation before they'll actually trade with them. And then to the interest point, look, there's definitely been a sort of a swing on cost around cost of money in these projects. Two things have happened there. A lot of funders who were traditionally funding energy service contracts have pulled out of the market. That means that if you do have a product that can enable an off-balance sheet solution, it's a more precious commodity, and therefore you've got a differentiated offer in the market. So it's quite a complex answer to that question, but hopefully that gives some flavour to it.
Yes, and you've given me a rather nice opening into a balance sheet question of your own balance sheet. So obviously in the RNS you did discuss potential strategic options. Can you talk us through what the board is looking at the moment?
Yeah, so look, we're not exclusively looking at equity as an option to strengthen our balance sheet. We've got a number of strategic partners that have shown an interest in supporting us. And I think that we are gauging investor sentiment at the moment around what we might do and when we might do that. So we're exploring a number of options. So we don't have any firm idea as to what route we're going to go down, but over the next few months we're going to hopefully land on an answer that will help support whatever we do. It's going to be the centre of that decision will be on enhancing shareholder value.
Okay, thank you. And I suppose sort of following on from that, how pressing is this decision in terms of supporting your growth ambitions?
So yeah, we've got forecasts out in the market. We're expecting to be modestly cash generative for the current period. We're forecasting, as we talked through in the presentation, to kind of get to a normalised operating cash generation for FY24. But I think what we're talking about in an RNS is a kind of recognition of the benefits that a strengthened balance sheet would give us.
Okay, thank you. Competitors, I know in our note we have listed lots of comparables for evaluation purpose, but in terms of on the ground, who are you seeing out there?
Yeah, look, another good question. And there are obviously a clear set of competitors for energy management, which are split between supply side competitors such as people like Inspired, who are our largest market player in the supply side procurement market, and then there are the consulting businesses, which are Schneider, for example, Accenture being the top two large ones, and then a lot of smaller, rapidly growing businesses that are entering and doing so well in this provision of services around energy consulting. On the energy services side, we have a number of different competitors, depending whether that's in the solar space. There are obviously developers, there are obviously installers. We don't have any sort of present threats that we see as being directly competitive to our whole offering. So we don't really see a competitor offering the breadth of services we offer in energy services, either with or without the funding capabilities. There is a very interesting peer group comparable in America that we follow quite closely, and that's Redactive. They've grown from being a business that was market value about 50 million in 2018, has now got a billion market cap. And they look very, very similar to what we do in the UK in terms of that breadth of energy services using the funded solution.
A nice ambition there. A quick one on leadership team and how it's structured. Are there two divisional heads for MySolar and MyZero? Oh, sorry, just Solar and MyZero. And how are these key people incentivized?
Yeah, so we've consolidated quite a lot of our teams over the course of the 12 months, and we've landed on quite a clean structure for both energy management and energy services. So in energy management, we have a divisional MD, Delvin Lane, who was the ex-CEO of utility team. Delvin works closely with a chief strategy officer who heads up all the commercial and consulting strategies for that division. Ryan, who joined us from the head of Schneider, who ran the Schneider consulting business for the last 12 years. Rob Van Leeuwen, who's our chief operating officer for that division, and a divisional FD. So the team in energy management is 4, and they're incentivized both through options and typical sort of LTIP structures. And then we've got on the energy services side a divisional MD, and we've got effectively a head of commercial who runs all of the customer acquisition strategies for all of our products and energy services. So we launched solar and eCharge and MyZero as product lines to create a minimum viable product to test and assess market appetite, pricing, and operational delivery capacity. And then we've merged that under one central operations delivery team, one central commercial operations team, all sitting under a sort of general leadership team of, again, 3 people. So 2 teams where Crispin and I support on strategy, finance, marketing, and general sort of corporate legal.
Thank you. And finally, then, unless anyone else has any other questions to add, what are your long-term ambitions for the business?
So I think we want to scale. We want to scale significantly over the next 5 years. We want to be cash generative. We want to have a good cash generation ratio to EBITDA. We want to be able to increase our margins at the EBITDA level. So we want to take energy services from a 10% EBITDA business to a 20% EBITDA business. We want to broaden out the breadth of our services. We want to be primed and ready for battery storage when we feel it's the right time. We want to be able to be in a position where we can invest into geographical territory expansion at the right time. The near term is about consolidating cash generation and building out a robust balance sheet. And then it's about trying to get as much efficient scale as possible using technology to get that operational gearing and to build a business that's, got a 10-year strategy.
That's a really clear outline of what we can look forward to hearing more of over the next 6 and 12 months. Thank you for all of you who have joined us today. A reminder, if you could do the feedback as we exit the webinar. And thank you to both of you. We look forward to hearing more in 6 months' time.
Thank you. Thanks.